In this final video for merchandising operations, we're going to be talking about some financial reporting issues. For a merchandising company, they have two different income statement formats that they can choose. One is what is known as a multi-step income statement, which is going to include computations of subtotals such as net sales, gross profit, income from operations, as well as net income. In a single-step format, there are no subtotals and there are no differentiations between operating and non-operating items. So on a single-step income statement, expenses are subtracted from revenues to come down to net income. So in terms of those subtotals on the multiple-step income statement, net sales is something we talked about in the previous video, and we know that it is calculated sales returns minus sales discounts minus sales returns and allowances. Gross profit is equal to net sales minus cost of goods sold. Operating income is gross profit minus operating expenses, and net income is operating income plus or minus other revenues and expenses. So what are operating versus non-operating items? Operating expenses are going to be cost incurred in connection with the primary operations of the business. So if we are talking about Target, their primary business is buying goods for resale, and any of the costs incurred in connection with that are going to be operating expenses. So operating expenses are typically classified as selling, general, and administrative expenses, and operating profit is going to be the profit that you are generating from your primary operations. So it's calculated as gross profit minus those operating expenses. Non-operating revenues and expenses result from peripheral transactions and include gains and losses. So for example, if Target has excess cash on hand and they buy the bonds of another company, in other words, they loan another company money, they're going to earn interest income. That's not their primary operations, it's a peripheral transaction, so it would be reported in other revenues. Examples of non-operating revenues and expenses include interest revenue, interest expense, dividend revenue, rent revenue, and gains and losses on the sale of plant assets. Operating expenses are typically referred to as SG&A, which stands for Selling, General, and Administrative Expenses. These are costs incurred in connection with the primary operations. Selling expenses are costs incurred to market and distribute products and include sales salaries, advertising, freight out, and depreciation on sales facilities. General and administrative expenses are costs incurred to administer the overall operations and include office salaries, insurance, rent, and depreciation for office facilities. Here we have an example of a multiple-step income statement for Dollar General. You see it's net sales minus cost of goods sold equals gross profit. Subtracting out SG&A, you come down to operating profit or operating income. They have one non-operating cost, and that is interest expense. We're coming down to income before income taxes, income tax expense, net income, and then our earnings per share calculations. Then we have Target's income statement, which is what I'm going to call kind of a hybrid format. We do have sales and other revenue to come down to total revenues, and then we do not have the subtotal of gross profit because we've got cost of sales, SG&A, depreciation and amortization, and we are coming down to the subtotal of operating income. They also have one non-operating item, net interest expense, that they're subtracting out to come down to earnings from continuing operations, a provision for taxes, and net income from continued operations. Apparently at some point they have a discontinued operations, which that discussion is beyond the scope of this class, but at any rate, this is not a strictly multi-step, it's also not a strictly single step, so we're going to call this a hybrid example.